Destination Africa, brought to you by Standard Bank.
Hannes, let's pick up on a conversation, starting to look at the positioning for profitable growth in a post-recessionary environment. So things like customer reach, comes into that, tailoring products to meet specific market segments and channels as well. How much attention do you pay to data specifically, which generally doesn't exist beyond South Africa's borders?
Within a South African and outside South African borders, we do a lot of research on the market size. Mm-hmm. We are led quite a lot by the retailers. In other words, somebody like Shoprite or Game or one of those bigger retailers would actually tell us or ask us, have we looked at, say, Botswana or Kenya or wherever the case might be? So yes, we do that, but unfortunately also in a recession period like this, the retailers base a lot of their decisions on yesterday's sales, and yesterday's sales haven't been that great. But luckily, we take a 4 or 5 year view, because it does take a long time. It takes you at least 2 years to build a shopping centre, 18 months to 2 years, and to put the whole scheme together can take you 4 to 5 years. So we do take a longer term view, and then we do a lot of research as to the size of the market and then base our shopping centres on that.
Well, Derek, it seems like a lot more focus would be paid to, macro data, especially when you're looking at target countries. I mean, there's caution out there for investors in the retail space to be wary of consumer spending that's dependent, for example, on donor funding, and Mozambique stands out as one country whose majority of its budget relies on donor funding specifically.
Donor funding is obviously one of those anomalies that you would love to take into account, because it keeps on happening day after day and year after year. But focus areas for the countries that donate the funds also change over time, and one almost needs to be ahead of the curve, so to speak, and factor that into your investment decisions.
And of course, affordability then becomes imperative as well. It's really where your homework needs to be done. And I've come across reports saying that adding, bells and whistles to your product offering may not warrant the premium on price specifically as it does on some other continents. So what's your view on that?
There are certain categories of spending which will always, from a consumer perspective, be aspirational, which is an individual telling you something about themselves in the way that they buy and consume certain goods. But I do agree with you. Fundamentally, the name of the game in the big part of Africa and the developing world is a core product with core features that work very well, and where the bells and whistles is something that may be added in the fullness of time. But in order to establish the brand, gain the trust of the consumer, those core features become far more important in the early days, as one seek to build on that.
And now more than ever, Syd, probably, important to think about the market that you're actually targeting here. So let's look at low-end entry strategy for one. I mean, this could be an entry point strategy that retailers could use when moving on to the continent, where the growth potential in targeting the low-end market seems to be one of immense nature. What's your view there?
You know what your problem is? Africa has, let's say for argument's sake, 1 billion people. But of the 1 billion people, there will be only a very small percentage of people who have what I'd like to call real spending power. The rest of it is hundreds of millions of people with only tiny amounts of money. Mm-hmm. Now, in a way, that kind of exists in South Africa as well. That's why Shoprite created USave, for instance, to target the LSMs 1 and 2 consumers who have very little amounts of money, but they were located in such a way and in locations where the cost of distributing merchandise from a distribution centre through to that store was most cost effective. In other words, it would be typically on a route from the DC to a large store located somewhere else. Mm-hmm. Now in Africa, you don't have that infrastructure. You don't have those beautiful, wide tarred roads, for instance, and in order to make money, you can't exist with 1 or 2 small USave type stores. You need a larger number of stores, because your gross margins in those stores are obviously typically very low.
Yeah.
And your problem in Africa is finding infrastructure like roads and things of that nature to enable you to establish a large number of stores to which you can distribute cost efficiently in order to make money.
But if you're getting economies of scale like that, right, Derek, I mean, it does put you in an advantageous position, because to bear in mind is that you're competing against pre-existing local suppliers within those territories already, who may already be, well connected and have informal practices, and that presenting an uneven playing field. So would you agree with Syd that, achieving economies of scale here is pivotal to your success on what is an uneven playing field at this stage?
I absolutely agree with that. I think it's very important that you figure out how to get your product to your consumer in the right format. And so the debate around packaging sizes is also quite evergreen. I agree with him that you need the infrastructure, but not only do you need the infrastructure, you also need to cater for your consumer to use your product in very different ways. I doubt very much whether you'll have much success at selling a big hamper of any nappy that you could think of in bags of 50. You may want to sell them in 1s and 2s, because that is how much your consumer could use. So not only do you have the infrastructure change, you also have a very different mindset, because economies of scale is based on standardization and doing the same thing incredibly well. That, to a large degree, needs to be undone if you want to interface with your consumer.
So innovation key to getting those robust margin growths, coming online. Robust margin growth is achievable, though, and it's probably sweetened by the fact that, consumer credit is not very much an option in many of these African countries. Cash is still the major currency.
In the food business, doesn't matter where you are, it's a cash business. The credit only really applies when you talk of, semi-durables, apparel and furniture and what have you. But the apparel retailers have largely kind of avoided Africa, save for a few retailers who've gone in via the franchise route. But the franchise route, of course, eliminates any need for financing, because the letter of credit is normally established and settled before the goods actually leave South Africa's borders. So the South African retailer actually carries no credit risk at all, and he doesn't really care, whether the operator in Africa offers credit to customers or not. As generalization, they don't offer credit. But that's how it works. And the one great furniture retailer who did go into Africa offering credit, the one that did it on a grandiose scale, went bankrupt.
And therein lies one of the
10 years
risks
ago.
as well. If you're looking at strategy, you've got to adapt, and that's what we've been talking about, adapt in order to survive. Derek, for now, the risk also comes in, what we've been speaking about, the fact that we're looking at low trade volumes. We've seen, retailers paring inventory levels quite dramatically to improve cash on hand, especially in a tough economic environment, eliminating the need, to mark down goods so that they could drive traffic moving forward. Is that part of the strategy, when it comes to getting that operating environment to work in your favor?
I think there are two things that are pulling up in different directions. I think for the last 2 years, most companies around the world have focused aggressively on working capital, really making sure that they optimize the way in which they budget and plan, and the way in which they structure their supply chain. I think one of the things that is pulling in the opposite direction is, I think, doing business in Africa requires you to do exactly the opposite. The supply chain is much longer, the supply chain is far more complicated, and in order for you to not have the opportunity cost of a lost sale, you probably need to invest ahead of the curve, which means you may, and maybe the analogy is back to Syd talking about the 93 and the 7%. In South Africa, where you have a sophisticated market, where 93% of your profits are coming from, that's where you run lean and mean, and that's where you invest the money that you earn into a longer and more complicated supply chain to build your business into Africa. And I sense that's how you want to try and get those two things to work together for mutual benefit.
Hannes, so just to wrap up, what are you anticipating in terms of upcoming trends as retailers plan, to capitalize on future growth areas on the continent?
It's a difficult question to answer, but I think, specifically speaking from a developer's point of view, doing business in Africa, we would prefer to go with the bigger retailers, make sure that when we put those shopping centers together that we have larger nationals going in. You don't have those small moms and pop shops that you get in South Africa, the independent retailers. They're very far and few between. So yes, when we do go into the rest of Africa, it'll be larger box tenants and shopping centres.
In managing the risk as an investor, where should your priority lie, Syd?
Well, that's a tricky one, because you could turn around and say, I want to take the lowest risk route, and that is I'll back a retailer that goes in via the franchise route, because essentially there's virtually no risk.
Yeah.
But it's always the risk and return story, because the moment you go in via the franchise route, you go completely against the grain of one of my personal views, and that is the profits in retailing are ultimately made in the shop. That's where the biggest component of the profit is made, in the shop with the interface with the consumer, because that's where the selling price is ultimately dictated. Now, if you give up that portion of the profit, what's left, going the franchise route, which is the low risk option, actually leaves you with very little return. Sure, it's a no risk return, but at the end of the day, if you really want to make money, you've got to take the risk, and you've got to own the interface, the shop. And that is why go and talk to ShopRite and ask them why, not only in South Africa, but most definitely in Africa, why they have kind of avoided the franchise route for that very reason.
Well,
okay, Mr. Basson has another view as well. He says, because then I have control over what happens in my shop. The moment I don't own the shop, I don't have control over my brand. But at the end of the day, the profit is made. That's my view. The profit is made in the shop.
Well, good place to leave it. Let's leave it there. Thanks so much, gentlemen, for joining me at the desk today. Of course, Syd Vianello, retail analyst at Nedbank Capital, Derek Engelbrecht, retail and consumer product sector leader at Ernst & Young, and then Pickard, director and founder of Retail Africa as well.